Market over here. Just trying to get something going here real quick. This is the What Are My Options show by your host, Sean McLaughlin, at Option Sean on the old Twitter X. And this is a kind of a free-for-all show where we discuss concepts and options trading. I answer questions. This is I want you to send me your questions and I will answer them as best as I can. I do have a couple topics that I would like to discuss before we get started. I see some people coming into the chat already. I see Dave. I see SM Traz. I see Dan. Hey, Dan. I see Harminder, my number one fan. Hey, Harminder. Great to see you guys. So while I wait for questions to come in, hold on. I gotta like blow my nose or something. Got a little runny nose action. See, live show, man. This is what happens. All right, so I wanted to talk about one thing here before we get too far down the road on questions. This is relevant to the All-Star Options community. We've got a trade on right now that we've been in for a long time. It's a trade that we got into back in May. Gene, if you want to bring up my screen, you can, or my chart, you can. This is Canadian Imperial Bank of Commerce, ticker CM. We've been in this since May. We're long the January 75 calls that we paid $1.50 for. We are riding high on this position. This has been a big winner for us. This is going to be a great way to start the new year, booking a big win here. We've already sold half of it for 11.15, already locking in some great gains. And whatever we sell the remaining half of the portion of this trade for just adds to our totals. Wonderful, wonderful. Now, why I want to bring this up is because we are in January. This is expiration month for this trade that we've been in since May. And one of my best practices is when I'm holding long calls or long puts, any trade with open-ended profit potential, right? When I get into expiration month, I want to start tightening up my stops and getting out and booking the gains, right? I've done really well at holding this position since I got in. And luckily, this position hasn't given me too many episodes of heartburn, right? It's been a pretty smooth ride. We had a little pullback here in late July that was, concerning. Okay. But other than that, we've had a nice steady run up and, we consolidated. I guess we had a little fall here in late November, but this one was less concerning to me because I had already taken half off the table. So I was already a guaranteed winner in that one. So again, this one hasn't been too hard. They're not all like this, right? They don't all be a nice, smooth, easy ride. But now that we're in expiration month, it's time to not let the rest get away. All right. So what I like to do, and there's no magic in this, guys. There's no magic at all. But I like to start trailing a stop loss level somewhere below the 3 to 5 day trailing low. So let me zoom out or zoom in here a little bit. It's kind of messy with this number kind of getting over the candlesticks, but you can see here in the last 1, 2, 3, 4, 5 trading days, including today, the low for CM has been 90.50. It's kind of right in there. It's hard to see it, but it's $90.50 is the low. I don't want to see CM break below 90.50. If it does, that's my signal to get out. Now, I might get whipsawed and this thing might go screaming higher again from there, and that's fine, right? We rarely, if ever, get out of the top. Every so often, we get to hold one of these trades all the way into expiration day. It's happened more often than I would have thought, to be completely honest with you. And maybe this one will do it too. But we are what? 10 days until expiration? Not even. It's next Friday. So what's that? 5, 6, 7 trading days from now. So either way, we're getting out in the next 7 days. But if we break 90.50, that's my signal to get out. And you guys hear me talk about this a lot, especially All-Star Option subscribers hear me talk about this a lot. I usually wait for closing prices when I want to get out of a trade. I'll wait for the closing price and then I'll exit at the open of trading or, the early morning of the next trading day, assuming it's still below my stop loss level. That's normally how I will exit positions. But in this case, with options that are nearing expiration, and I'm just trying to lock in some profits, if I get a break below 90.50 intraday, I will effect an intraday exit, assuming I'm at my desk when it happens. I don't have a stop loss order in the market. I strongly urge you not to use stop orders with options. because options tend to get illiquid at the moment you need them to be liquid. Or maybe I should say that better. Bid-ask spreads tend to widen the time you need them most. All right. So when you're looking to get an exit, you'll notice that market makers are no dummies. When stocks are breaking certain levels, market makers will widen the bid-ask spread. Now, that doesn't mean you can't get filled at the mid price. In fact, you can get filled at the mid price in most cases, especially if it's a liquid options market. But if you put a stop loss order out there, and let's say your stop loss, I'm just making up numbers here. Let's say you own a call contract and your stop loss is $3, right? You don't want to sell the, if the option gets below $3 fair value, you want to sell it. Well, unfortunately, what's going to happen in many cases is if a stock's going against you, it's going down. The fair value of that option might be $3, but all of a sudden you'll find that the bid is $2 and the offer is $4. The mid price is 3, but if you have a stop loss order working in an option, that as soon as that mid price gets below 3, it's going to trigger a market order. You're going to sell on the bid, which is going to be $2, giving up a full dollar of what you should have gotten when you should have gotten 3. Now, that's a lot of change to give up. So don't use stop loss orders, please. The only options contracts that you could maybe use stop loss orders are things like the SPYs and the Qs. But even there, I don't recommend it because bid-ask spreads have a habit of widening at the time you need them to be tight. So what I do is I have that chart level here at 90.50. I've got a stop. I got an alert set on my trading platform. As soon as 90.50 gets broken, I'll get a little bell that'll go off when I'll get a little notification on my phone telling me time to exit this trade. And then I'll pull up the chart and I'll work my order. I'll put a limit order out. I'll patiently work my limit order somewhere in the mid price between the bid and ask to get out. And that's how I get out of the trade. All right. So there's a little execution tips for you guys in options that are a little unique compared to stocks. If I held a stock position in CM, then certainly I would just use a regular stop loss order and not have too much concern about getting a bad fill. But with options, you got to be a little bit more careful. Options market makers are more than happy to give you some serious slippage on your entries and exits, especially if you're using a market order. So don't ever use a market order on options. Okay, capiche? We understand each other? Great. All right. Let's get into some questions here. I hope I explained myself there with holding trades into expiration. Robert says I've got the best intro music. You know, I didn't hear it today. All the credit on that goes to Gene. He's the guy working behind the scenes making this stuff work. So shout out Gene for the good intro music. The fans love it. All right. All right, let's see. Questions here. Nvidia. This King Dave is asking about Nvidia. Well, I'm in Nvidia. I'm in a call calendar spread right now. You can see it on my chart. I'm short the February calls and I'm long the April calls, all of the 210 strike. I paid $465 for it. And my trade, I did that. Why did I do that? I did that because I am bullish on Nvidia, but I have a feeling it could take a little while. And right now, it seems to be taking a little while. So I can get paid to wait here on this Nvidia trade in my call calendar spread. As long as it doesn't break above 210, I'll continue holding this trade. Or if it breaks below 170, as you can see, that's my stop. But with a call calendar spread, one thing you should know with a call calendar spread is if you still have the full spread on, if the short February 210 calls are still active, right? We haven't gotten to February expiration. If Nvidia trades to 210, while I still have those short February calls, I will close the spread there and book my profit. Now, that's not what I'm hoping will happen. What I'm hoping will happen is that these February calls are going to expire worthless. So Nvidia might just kind of, trickle higher a little bit from here. That would be an ideal scenario, but it never quite gets to 210. The February calls expire worthless, and then I'm left with the April calls with the potential for unlimited gains from there. That's the hope. Doesn't always work out that way, but that's the hope. We've had a couple trades that have worked out that way. Some big winners last year. MRUS comes to mind as one of them, where we put a calendar spread on the calls expired worthless, and then, or the short calls expired worthless, and then the long calls were ripped later on, which was great. I would love for that to happen in Nvidia. But if we get to 210 before those February calls expire worthless, then I have to close the spread because, and I don't have a graphic here for you to show you real quick, but a call calendar spread, the max value, or the max potential gain of a call calendar spread is right at the strike at 210. If Nvidia closes February expiration day at 210, then that is the maximum profit I could get in that trade because the short calls will expire worthless, and then those April 210 calls have a lot of value. But if you start getting away from that strike price, if we go beyond 210, okay, here's what happens. As both of those calls go more and more in the money. Let's say Nvidia has like a freak, not a freak, but it has some great news or something, and it has an overnight gap, and the stock opens at 275 bucks. It could happen. It could totally happen, right? If Nvidia gaps to 275 bucks, well, what's going to happen is both of those calls are going to be so far in the money, both my short call and my long call, that there's going to be next to zero premium left in those calls. They're both going to be trading at their intrinsic value. There's going to be no premium left. All right. So that short February call with the stock at 275 is going to be worth 65 bucks. All right. But guess what? The April 210 call is also going to be worth 65 bucks, maybe 65 bucks and some change, or a little bit of premium just to feed the premium gods. But basically the two options will be worth the same. So when I close them, I'll get nothing for it, right? I'm going to buy one for 65 bucks and sell the other one for 65 bucks. Net zero. So this 465 debit that I paid, that's the most I could lose in this trade. But I don't want to let Nvidia go beyond 210 if I'm still holding the short February calls. So when I get to, if we get to 210 or even a little bit beyond it, I will close the trade, book what will likely be a profit, and move on. That's great. Not the profit I was hoping for, not the unlimited potential gain I was hoping for. Still a profit. I'll still be happy about it. But that's another best practice. We've been talking about best practices today. That's another best practice for me. Calendar spreads, close them when they get to your strikes. All right. Don't sit around and wait and hope that, here's the thing we'll call calendar spreads. The closer you get to expiration, like the closer you are in time, the more the spread could potentially be worth. Don't be one of those people that if Nvidia gets to 210 tomorrow, that you're going to be like, oh, I'm going to sit here and hold it for a couple more days and maybe sell it, 3 days later for a little bit more money. Don't be that guy or girl. You're asking for trouble. Just close the spread at 210. So Nvidia. So I went all over the place there in King Day. So I'm already in Nvidia. I like it. That's the trade I'm in. I'm in a call calendar spread. What's up with Google? Google's looking real nice here, right? That's a trade I like. That's a setup I like. In fact, that looks like a thing you could buy right now. Yeah. Yeah, you could buy that right now. Let me bring up my other platform here just to look at the implied, or not this. We don't want the simulated account. We want the real account. We want the real account. Yeah, there we go. Let's bring up the Goog. Let's look at the options chain on this, or the option implied volatility. So implied volatility is relatively low, not at the lowest. When it's at the lowest, that's when I tend to like to buy calls. Although this is an expensive stock, it's a $321 stock, so calls are just in absolute values are going to be expensive. You can see I'm in a February bull call spread here. You can see it here. I'm long the February 325s, short the 335s. I'm up just a little bit in this trade right now, not a whole lot. This is in my short-term options account. But yeah, a bull call spread is the way I played it. I played it that way because the options are expensive. I mean, look at the money call here. This is just in February. We only have 44 days of expiration. The at the money call here, or just slightly out of the money call, is 14 bucks, 14.50. It's going to cost you, if I paid the offer right now, it's going to cost me $1,450 per one lot. I didn't want to risk that much money. All right, in this short-term account here, I risk no more than 400 bucks per trade. All right. And so for me to participate in Google without, risking more than I'm comfortable risking, I had to do a bull call spread that I think this cost me like $350 to get in, somewhere in that neighborhood when I put the trade on. So kept my risk under $4 or 400 bucks, but my gains are capped because here's the P&L graph of this trade, right? This purple line is what the P&L could be across a range of prices today. This is where we are right now. Let's clean this up a little bit to make this a little easier to read, a little easier to see. So where this vertical line is, this is where Google's trading right now. You can see I'm making money in my trade, not a whole lot, but that's how my P&L would trend over a range of prices today. The blue line is what my P&L will be on expiration day. And you can see the trade-off that I've made by risking less money using a bull call spread is that my gains are capped, right? The most I could potentially make in this trade is 620 bucks. So I paid 380 if I do my math correct. I put this spread on for 380. That's the most I could lose. You can see right here. The most I could lose is 380 bucks in this range. If it goes higher, if it goes above my short strike at 335, my gains are capped. The most I can make is 620. Now, I'm not going to hold that spread if I'm in it, or I am in it. I'm not going to hold that spread all the way to expiration and try to sell it for the full value, right? The full value of this spread, the most this could be worth is 10 bucks. Okay, you buy it for 325, or you're long the 325 calls, you short the 335 calls. The distance between those strikes is 10 bucks. That's the most that spread could be worth on expiration day. I'm not going to hold it that long. I will sell this spread if I can for 8 bucks. If it gets, I've got a good, in fact, I have a good till cancel order out there working right now. I think I do. Yeah, I do. I got a good till cancel order out there working to sell this spread for 8 bucks. And if I get it, I will be happy and I will walk away. I don't want to risk the $8 that that spread is worth to try to make another $1 or $2. That math doesn't work for me on bull call spreads. It's the 80-20 rule. Once I've achieved 80% of the maximum value, I am out. So I like Google. I'm already in it, as you can see, but I mean, for a fresh entry right here, feels like a good fresh entry. Do it with a bull call spread. If you want to give yourself some more time, which seems like a good idea. I mean, I bought these a little while ago. If I were doing a fresh trade right now, I'd probably look at the June options. That gives me almost 6 months. I'd probably do a bull call spread again. Let's maybe do the 330 calls. Um, let's see. For those of you with bigger accounts and bigger comfort levels of risk, maybe you go as far out as you know what? I think what I would do is if I'm going 6 months out, I would look at the 350s and the 400s. The 400s have, maybe that's too far. I want to do a $50 wide spread. So we'll buy the 340s. Guys, there's no magic here, right? There's no magic. I just want trying to catch the meat of the move, right? If this thing's going to rip, it's probably going to make a run to 400. That's my guess. Once we get above 350, you're going to start thinking about the $100 roll. You guys have heard me talk about the $100 roll. That's the phenomenon where big round numbers happen whenever a stock is approaching a big round number for the first time ever. Those big round numbers being 100, 200, 300, 400, etc. There's a phenomenon that happens that stocks just tend to get magnetically pulled. It's human nature. People see those big round numbers and they think it's going to get there. So if Google breaks out here and gets above 350, then you got to start thinking about the $400 roll. And so I like doing maybe the 340, 390 bull call spread. You could pay 14.10 for that right now. That feels like a good trade. So if I were getting into a fresh trade in Google right now, I think that's what I would do. I would buy this June 340, 390 bull call spread for 14.10. All right, let's see. If you wanted to get into APH in this consolidation, let's see what APH is looking like. Good looking chart there. If you want to get in, but it could chop around, but only risking a few bucks stock wise for a long play, how would you do it option wise? So if you're worried about it chopping around, which is a good worry right now. I mean, we're kind of going sideways here, right? In this trade. The trend is higher, so we've got that in our favor. The odds are when this thing resolves, it's going to resolve higher, but it might not resolve higher on our time frame, right? So this trade, much like the Nvidia trade, to me, I was going to say, you know what? I was going to say this looks like a call calendar spread to me because I think it could take its time and we could get paid to wait. But as I was saying that, I noticed I look down to my bottom of my chart and I do this for every trade. I look at the implied volatility. What's the implied volatility telling me? The implied volatility is rising, as you can see. It's not at the highest levels of the year, but it's kind of right smack in the middle, right? And when it's right smack in the middle, it doesn't mean you can't make money being long premium, but you're kind of swimming upstream because volatility tends to mean revert. Never on our schedule or never on our calendar, but you can expect it to mean revert eventually. And so when I see volatility rising, I hesitate to buy calls or buy a call calendar spread, which is also a spread that benefits from rising volatility but gets hurt by falling volatility. So if I wanted to put a trade on here, and I think it might wait, I think the trade that I would consider here would be a bull put spread. This is a short premium play where I'm selling premium. This is a mildly bullish trade because really what I'm doing is I'm making the bet that the stock is going to continue going sideways, might come down a little bit, won't come down too far. Okay, let's mock up what this trade might look like. So let's when I'm doing short premium trades, I like to do the second month out. So right now January is the front month. We got 9 days left in January options. So I'm looking at February options. We have 44 days expiration. Generally speaking, when I'm selling premium, I want to sell premium with 4 to 8 weeks expiration because that's when the premium acceleration or the premium decline tends to begin, accelerate, theta decay. That's the word I was looking for. So let's look at the February options. Let me bring that chart up real quick again, just see where our support is. It looks like 130, about 130 seems to be a good level of support. I mean, we broke through it briefly over here, but 130 seems to be a pretty important level. So let's see if we can sell some 130 puts and get some good premium. We can. Look at that. The 130 puts are offering. You could probably middle out on this thing and get filled at about 465. Okay. Now, I don't advocate selling naked puts in stocks that you don't want to own. Right. And I don't know what the story here is with Amphenol. I don't know much about it. I'm generally pretty uncomfortable selling naked puts in anything but the largest, biggest cap stocks, the biggest cap stocks that tend not to have violent, sudden movements against them overnight. All right. So in this case, I'm gonna do a spread. So I'm gonna protect myself, define my risk. I'll do a bull put spread. So what I'm gonna do here is I'm gonna analyze selling a vertical spread, which is another way for another word for a bull put spread. Let's do it maybe $10 wide. No, I think we can go. Yeah, let's just do $10 wide. Keep it simple. All right. Looks like I could get $2.42 selling the 130 put and buying the 120 put. Let's bring up a risk profile, see what that looks like. Let me clean this up again. I wish it didn't default to the 3 slices. Okay, so here's where we are right now. Okay, trading around 138. If we sell the 130 put and buy the 120 put and collect 242, as long as we stay above 130 between now and expiration, we're going to keep all that premium. Both of the puts will expire worthless and we'll keep the $2.42. Not a huge win, not a home run, but a high probability win, right? Right now, the options market is telling me, give or take, let me set these dates here, set this to February expiration. It's telling me right now, see this, I don't know if you can see this, but it's nearly 63%. I have 63% odds of success in this trade, meaning the market is pricing in the likelihood that that there's a 63% chance that APH will close above 130 on expiration day. Now that's just good information. It's not something I trade off necessarily, but it gives you peace of mind, right? I only have a 36% chance of losing. All right. But actually, let's move this a little bit further here because our break even is actually lower than the strike of the 130 strike because of the credit. Our break even is actually going to be 127.50, give or take. So actually, our chance of making money here is closer to 67%, a little smidge higher, right? So here's with this trade. There's 5 scenarios. I talk about the 5 scenarios of any outcome for any trade that I ever put on, right? The outcomes are the stock can go way higher, right? That's outcome number 1. The stock could go a little bit higher. The stock could go sideways, do nothing, right? The stock could come down just a little bit, or the stock could collapse, have a big drop, right? Well, when you put a bull put spread on, out of those 5 scenarios, there's only one of them where you actually lose, and that's if we have a large loss. Because you can see we're trading right here at 138. We could go down a little bit. We could go down as much as $8 and still make money in this trade. All right. Of course, because we have high odds of success, we're not going to make a whole lot of money. The most we can make is this 242 that I could sell this for right now. Okay. But it's a high probability of success. So going back to this chart, I think that was Dave that asked this question. Yeah, I'm bullish on this chart, but I'm still waiting for a catalyst for a breakout, right? I wouldn't want to get aggressively long until maybe we broke above 144 and into new fresh highs there, right? So for now, we could play the sideways consolidation and get paid for it. And the stock might not even break out at all. We could still make money, right? But if you just bought calls on this, which is a common thing to do when you're bullish, and the stock continues going sideways, you're not going to make money. In fact, you're going to lose money. So bull put spread in a situation like this could play in your favor. And this works most, and the reason why this is a great trade for me is because of the rising implied volatility. Because here's the thing too, if the stock continues going sideways, then every day that it goes sideways brings me closer to expiration and closer to realizing my profit. But also, if it keeps going sideways, likely implied volatility is going to fade away. All right, because market people aren't going to be scared. Now, the volatility may be rising because we have earnings coming up pretty soon, and that could be something to worry about. In fact, I think I could pull up the earnings date on another platform here. Let me find that for you real quick because that's important. APH earnings date is January 28th. Okay, so that's important information, right? If we're selling the February calls, then we're gonna have to worry about earnings. Something to be concerned about. But remember, putting this spread on, our risk is defined. The most we could lose is $755 in this trade if we sold it for 245, right? Sold it for 245. The most we could lose is 755. How does that number arrived at? The distance between the strikes is $10. So the most that spread could be worth is $10. If both of these puts are in the money at expiration, they're going to be exercised against you, and it's going to cost you $10. But you collected 245 on the way in, so you take 10 bucks, subtract the 245, and you arrive at 755. That's the most you can lose in this trade. But regardless of earnings coming up, I like this trade because I've got defined risk. All right. Now, when it comes to position sizing, if you put this trade on, this number, this 755 number is a number you need to pay attention to. That's your max risk. Okay. So you don't want this number to be more than 1% of your portfolio, maybe 2% at most. Okay. Some of you with smaller accounts, maybe you have to do that. But you don't want $755 to be more than 2% of your account. If it's more than 2% of your account, you either got to go smaller or you got to skip the trade. That's just prudent risk management. So if I have a $50,000 account, okay, and I'm comfortable risking 2%, that would be $1,000. Okay. I could put this trade on. I could do a one lot. I can't do a two lot because if I did a two lot, I'd be risking $1,500. All right. That would be 3% of my account. That's too much. I'm not willing to risk that much. Okay. But I am willing to risk less than 2%, which is in this case, 755 bucks. So position sizing is so important. I talk about this all the time. Don't put yourself in a position to lose big. All right. Losing big screws up the math. I talk about this all the time. I'm a broken record for those of you who've been paying attention to anything I've been doing for any length of time. Big trades screw up the math, or big losing trades screw up the math. Okay. Because if you're an options trader like me, if you're a trend follower like me, typically, I mean, I do all kinds of trades, but at the end of the year, every year, my biggest wins were always in stocks that had the potential for unlimited gains, right? Long calls, long puts, calendar spreads where the short call expired worthless and I'm left with the long call, right? If I have a big losing trade, the math doesn't work because what's going to happen is when you look at all your trades at the end of the year, which by the way, we're going to do a portfolio review tomorrow. You should tune in tomorrow at 3 o'clock Eastern, All-Star Options, very special show. We're going to be reviewing the performance in All-Star Options last year, which was amazing. We more than doubled our account last year. Amazing. But when I look back at all the trades, my win rate is less than 50%. In many strategies, my win rate is lower than 30%, right? But my wins are, but I have a whole bunch of small wins and small losers. And those net out to basically zero, right? But it's 5 or 6 or 7 trades out of 150 trades that make my year because those were big winners. But if I had a big loser in that mix, that screws everything up. Screws everything up. So do whatever you can to not take a large loss. Large losses will kill you, not physically, but they will kill your trading account. Don't do it. All right, let's see. Let's see. I'm looking through the chat here. I see a lot of hellos. Hello to you. Hello to all of you. Let's see. Some. Oh, I just lost it. Somebody said he wanted to get roasted. Where was that? Lost that. Johnny Finn. He bought SLDP. Said he wants to get roasted. Let me pull up that chart. I'm not familiar with this one. I started a 515. Was it a May 15th call? You bought the 550 strike. You paid what'd you pay? Let's see. May, let's bring it up here. You bought the May 550 calls. You paid a buck for them. I got no problem with that. What do you want me to roast you for? Your risk is defined. You're playing on this bounce here. I mean, I don't know where your stop is. If you have a stop, I mean, I would probably not want to let this thing get below 475. I got no problem with that, Johnny Finn. It's not a trade I would get into, but that's what makes a market, man. That's what makes a market. I don't like that it's below its 50 period moving average, so that would give me pause. I think I would probably want to wait till it got up above 6 before I got involved, which is above this prior peak. Even then, it could be tricky because you might have a lot of bag holders up here. But hey, man, good luck. I like the way you did it. You defined your risk. You got till May. It could work. Frey Lee asks, this is a good question. How many days out from expiration do you hold if it's profitable versus not profitable? Well, the days expiration don't really come into play for me. Um, I mean, it comes into play when I'm putting the trade on, right? I choose my expiration based on how long I think a move needs to mature, right? Um, but my stops generally, this is not always true, but my stops are generally chart-based stops. So I'm just looking at a level on the chart that tells me when I'm wrong. All right. I'm not paying so much attention to how close we are to expiration. That matters once I get into expiration month, which we talked about at the beginning here when we were talking about the CM trade. Once I'm in expiration month, that's when I get real tight with my stops. But otherwise, if I have several months of expiration, I want to give the stock every chance to prove itself, or every chance to fulfill its mandate of the trend that I'm in, right? But if it's not doing that, and the chart tells me that, not time, if the chart tells me that, if a level is broken that I see as an obvious level of support, that's my signal to get out, Fraley. Excuse me, I'm losing my voice. Okay, SM Traz asks, do I ever let contracts expire? Well, that's depends. If it's if it's a call, or if it's an option that's out of the money and it's worthless and I couldn't even sell it if I wanted to, then yeah, I let them expire. No problem. If it's something that's in the money, no. I try not to let them expire. I mean, it's happened before, mostly just through negligence because I forgot about it. But no, on expiration day, if I'm still in an option contract on expiration day, I'm looking to get out. And mostly because if I get assigned, let's say let's bring up the CM. Let's bring up CM as a perfect example. Let's bring that chart back up. So I'm long these January 75 calls, right? If the stock closes here at 91.75 or somewhere in this neighborhood next week, I'm going to get assigned the calls. Okay. Now, right now, my risk is defined to whatever the value of these calls is. But if I get assigned on the stock in the it's a very unlikely scenario. But if I got assigned the stock and then on that over that weekend, some news comes out that CM, I don't know, there's fraud or who knows, right? Something bad. I now have the risk of owning 75 or owning 100 shares per contract that I own. I own the stock. And if the stock gaps down to 50 bucks, I'm going to lose 20 bucks per share, which is huge. That's not the kind of risk I want. So I'm not holding these things into expiration. I'm getting out on the day of expiration if I'm still in it. And you can get out. Someone in my All-Star Options chat room was asking me the other day. He's like, well, sometimes when these calls are way in the money, you have huge bid-ask spread on expiration day. And it's like you can't get a fair fill, or he's worried that he'll get a fair fill. And I told him, I said, no, that's not true. In most cases, in my experience, and I exit a lot of trades on expiration day, especially in my short-term options account. I hold a lot of trades to expiration day. If a call is in the money or a put is in the money, you can get a fair fill at the fair value of that option. So let's say, let's use CM as an example, trading at 91.75 right now. Okay, the call options I own are at 75 bucks. So this stock is, if you do the math, it's $16.73 in the money. Okay, that's the fair value of those calls. So if I were to go out there right now and put a limit order to sell at 16.72, right? I'm pretty sure I'll get filled. And if I don't get filled right away, maybe I drop my offer down by a nickel, and there's a really good chance I'll get filled, because for a market maker, that's free money, right? They know they could buy that call at a discount, exercise it immediately, sell stock against it, and capture that risk-free $5 per one contract. A market maker will take that money every time. That's what their job is. Okay. So on expiration day, get out. You can get out at the fair value. You should have no trouble. In the odd case, it hasn't happened to me, but it could happen. In the rare case where you're stuck, you can't get filled to get out, even at a fair price. Even you've lowered your price, 25 cents or 50 cents. You're willing to take a 50-cent hit. I wouldn't recommend that, but you're willing to do that, and you still can't get filled. Then what you do is you call your broker and you say, "Hey, exercise my calls." As the owner of the long calls, you have the right to exercise those calls at any time. Okay. So you call your broker, you say, exercise those calls. You'll become an owner of 100 shares of stock at a strike price of 75 bucks. Just immediately, once you become the owner, you immediately sell the stock. And that's how you capture your gain. All right. Hopefully you never have to do that, but you can do that. That's the last resort. Okay. So hope I answered those questions for you guys. Let's see. Uh, bu- 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 Gene, how are we doing on time? Do we need to wrap this up soon, or do we have time to go a little bit longer? Okay, we got 5 more minutes, folks. So we'll answer some questions here. How about SE or C? Bullish on both. Both have already started to rally. Would you do leaps with C? So let's talk about Citigroup. Let me bring up my other platform to look at the implied volatility. So Citigroup implied volatility is not at the lowest, but it's low enough that you could consider doing leaps. I mean, if you're that bullish and you want a lot of time to let this thing rip, yeah, why not? I mean, let's just look at what some leaps might look like here. If you go to January, that's the first leap strike. Um, if you go to like a 25 delta call, let's go to 150 call, nice big round number. You can buy the 150 calls for about 590 right now, 585. If you're really bullish, that could be a good trade. Um, I mean, look, I'm in it. You could see I'm in it short term though. I'm in my short term account. In fact, these calls are in the money. They expire in 9 days. This is a perfect example of a stock that I'm trying to hold to expiration day. All right, and you can see the bid ask spread. It's bid 725, offered 785, right? That's a wide bid ask spread. But I know that with the stock trading at 121.36, these 115 calls are worth 635, right? Am I doing my math right? Yeah. They're worth 635. So there's actually a little bit of premium left in these calls, so I could sell it for more. But I'm sure I could get filled in the mid price there around 750, no problem. But yeah, I like C. Am I still good with the CPRT May 75 puts? I'm still in puts. You can see here, I'm long the February 3750 puts. I'm down in them currently. As you can see, I'm down about 31 bucks. I have 3 contracts. But this is my short-term account. I'm also in this trade in All-Star Options. Let's bring that chart up. How do I have trouble on my platform? CPRT. We are also long the May 3750 puts. We have more time on those. So I'm feeling pretty good about that trade. Maybe not in my short-term account, but certainly in my longer-term account, my longer swing trade account, the All-Star Options account. We still have till May. I like those. I like the CPRT. UNH, man, I'm not in UNH anymore. You see this blue circle here in UNH? I bought UNH stock. I rarely buy stock. In fact, I remember this day very well. It was early August. I was on vacation. I was at my cousin or my uncle's cottage in upstate New York on a beautiful lake in the middle of nowhere. And I get a call from JC. JC saying, Sean, I think now's the time to buy UNH. I think now's the time. And the stock had been getting killed, right? It was down in here. And he's like, I think it's now's time. And he was asking me for an options trade. And I told JC, I said, JC, UNH is the biggest healthcare provider in the world. And it's down 70, 80% off its highs. This is the kind of stock, this is the kind of trade you just buy stock in it and you tuck it away in your retirement account and forget about it for a long time. And that's what I did. Well, that's partially what I did. I did buy stock. I bought it right there in that blue circle. But I stopped myself out right here. I believe it was November 3rd. Stopped out right around here. Made money. Nice trade. I'm out. But do I like UNH here? I don't think I would buy it right here. I mean, look at it's getting rejected at its declining 200-day moving average. I mean, if it got back down here in the 250 area, maybe I consider buying it again for the long-term account, but I don't like it. I don't like it. Intel. I bought Intel calls today. That's looking good. Well, it was looking good. Let's see. Last one here because I know I got to run here. Let's look at EOSE. Is this actionable? Not to me. Not to me. I'd like to see it get at least above 1650 before I get involved on the long side again. It's just kind of caught in the wash right here. Don't like it here. All right, folks. I know there's more questions. I didn't get to all of them. I apologize, but we got another show coming up here on the network in just a little while. And Gene, the magic man behind the scenes, has to get set up for that show. So we're going to end it here. Thanks for tuning in to What Are My Options? We'll do it again next week, same time, same channel. Please do yourself a favor and tune in to my options jam session tomorrow at 3 p.m. Eastern. An important show because we're going to review the highlights of last year. And what a great year we had. All-Star Options portfolio was up 108% all in on all trades. That's 108% on the portfolio, not 100% win on one trade or two trades. That's the entire portfolio, more than doubled. So we're gonna review what worked, what didn't, and any lessons that we can glean from that. And there's probably many. All right. So tune in tomorrow at 3 o'clock. All right, folks, I gotta go. Thanks for tuning in. Be well. See you tomorrow. Take care. Bye-bye.